Let me tell you about the three numbers that changed my life. $100,000, $500,000, $1 million. These are not arbitrary milestones. These are inflection points where the mathematics of wealth building fundamentally shift, where compound interest transforms from a concept you understand intellectually into a force you feel viscerally, where your relationship with money changes in ways you cannot anticipate until you experience them. I remember crossing each of these thresholds. I remember how different investing felt on either side, and I have watched thousands of other investors cross these same lines, observing how their behavior and psychology changed at each level. Today, I am going to share what I learned, because understanding these milestones before you reach them can help you navigate them successfully. Most people think wealth building is linear. You save some money, it grows a little. You save more, it grows more. A steady, predictable climb. This is wrong. Wealth building is exponential, but it does not feel exponential until you reach certain points. Before those points, the growth feels painfully slow. After those points, the growth feels almost magical. Understanding where those points are and what changes at each one is essential knowledge for any serious investor. Let me start with a story that illustrates why these specific milestones matter so much. In 1951, I graduated from Columbia and moved back to Omaha to work as a stockbroker. I had about $20,000 saved, mostly from my childhood paper route business and various other ventures. I was young, eager, and convinced I knew exactly how to build wealth through intelligent investing. Over the next 4 years, I saved aggressively and invested carefully. I reinvested every dividend. I lived well below my means. I read every annual report I could find. And by 1955, I crossed $100,000 in net worth. I was 25 years old. That first $100,000 took 4 years of intense focus and discipline after college, and really 15 years if you count my childhood saving and investing. The progress during those years felt agonizingly slow. Some months my portfolio barely moved. Some months it went backward. I questioned whether my approach was working. I wondered if I should take bigger risks to accelerate my progress. Then something remarkable happened. The next 100,000 came in about 2 years, and the 100,000 after that came even faster. By 1962, just 7 years after reaching my first 100,000, I had crossed 500,000, and by 1963, I had reached $1 million. The same journey that took 15 years from 0 to 100,000 took only 8 years from 100,000 to 1 million. This acceleration is not magic. It is mathematics. But understanding the mathematics at an intellectual level is different from experiencing them emotionally. Let me share what I discovered at each milestone that I wish someone had told me earlier. Here is my framework for understanding these three transformation points. Each milestone represents a distinct phase in your wealth building journey with different challenges, different psychology, and different strategies. The first 100,000 is the proving ground. This is where you develop the habits, discipline, and emotional resilience that will carry you through everything that follows. The money itself matters less than who you become in the process of accumulating it. The 500,000 milestone is the momentum phase. This is where compound interest becomes visible and tangible. Your money starts generating returns that feel like real income. The psychological shift from accumulation to growth begins. The $1 million milestone is the freedom threshold. This is where genuine options open up. You could live off your investments if you chose to. You have real security. The anxiety that accompanies smaller portfolios begins to fade permanently. Let me take you through each milestone in detail. The first milestone, $100,000, is the most important and the most difficult. It is important because everything else builds on this foundation. It is difficult because you are fighting against the mathematics of small numbers while simultaneously building the habits that make wealth possible. Here is the mathematical reality that makes the first 100,000 so challenging. If you have $10,000 invested and earn 10%, you make $1,000. That is nice, but not meaningful. If you save $500 per month in addition to that return, Your savings contribution is 6 times larger than your investment return. At this early stage, how much you save matters far more than how much you earn on investments. This mathematical reality persists until somewhere around $100,000 at that point. 10% returns generate $10,000 annually. If you are still saving $6,000 per year, your investment returns now exceed your savings rate. The crossover has occurred. Your money is working harder than you are. This crossover is the first major transformation before it happens. You are pushing a boulder up a hill through sheer effort after it happens. The boulder starts rolling on its own momentum. Your job shifts from pushing to guiding. The psychological relief of this transition is profound. But getting to that crossover point requires sustained effort over many years. Most people give up before they reach it. They save for a while, encounter some obstacle, drain their savings, and start over. They repeat this cycle for decades, never accumulating enough for compound interest to take over. Let me share what I did during my journey to the first 100,000 that made the difference. I lived far below my means. When I was working as a stockbroker in my early 20s, I rented the cheapest apartment I could find. I drove an old car. I wore the same suits until they were threadbare. Every dollar I did not spend on lifestyle went into investments. My friends thought I was cheap. My family wondered why I did not enjoy my money more, but I understood something they did not. Every dollar spent was a dollar that could not compound. I treated every dollar as a future fortune. This mental framework changed how I saw purchases. When I looked at a $20 expense, I did not see $20. I saw what that $20 would become if invested for 40 years. At 10% annual returns, $20 becomes about $900 after 4 decades. Every small purchase was really a large future purchase in disguise. I focused intensely on increasing my income. In my early 20s, I taught investment classes at night to earn extra money. I looked for every opportunity to earn more, not just spend less. The combination of low expenses and rising income accelerated my savings rate dramatically. By my mid-20s, I was saving and investing over half of everything I earned. I ignored market fluctuations. When my portfolio dropped, I did not panic. I kept contributing. I viewed lower prices as an opportunity to buy more shares cheaply. This emotional discipline was perhaps the most important skill I developed during the journey to 100,000. Here is the specific advice I would give someone pursuing their first 100,000 today. Automate your savings so you never have to decide whether to save. The money should move from your paycheck to your investment account before you see it. Willpower is finite. Systems are reliable. Live on last year's income. When you get a raise, do not increase your lifestyle. Bank the entire raise. This single habit can double or triple your savings rate over a career. Avoid lifestyle creep, like it is a disease. The promotion that comes with a nicer car and bigger apartment might actually slow your wealth building. Keep your lifestyle constant while your income rises. Invest in low-cost index funds and ignore the noise. You do not need to pick stocks or time the market. You need to consistently buy a broad market index fund and hold it forever. The simplicity of this approach is a feature, not a bug. Build an emergency fund first. 3 to 6 months of expenses in cash means you can weather job losses, health problems, and other setbacks without selling stocks at the worst possible time. The journey to 100,000 typically takes 7 to 15 years, depending on your income. And savings rate, it feels endless while you are in it. But every day you stay the course. Every month you contribute, you are building the foundation for everything that follows. The second milestone, $500,000, arrives faster than the first because compound interest is now working meaningfully in your favor. If you earn 10% on 100,000, you gain $10,000. That $10,000 itself earns another $1,000 the following year. The returns are generating returns. The snowball is growing. The journey from 100,000 to 500,000 typically takes another 7 to 12 years, similar to or slightly less than the first 100,000. But here is what is remarkable. You are accumulating $400,000 in roughly the same time it took to accumulate $100,000. The acceleration is real and measurable. AT $500,000. The math becomes exciting. 10% returns generate $50,000 annually. For many people, that exceeds their annual savings rate by a wide margin. The crossover that happened at $100,000 is now dramatically pronounced. Your money is definitively outworking you. This is also the milestone where the psychological relationship with money changes most profoundly. At $100,000, you have a nice nest egg, but you do not feel wealthy. At $500,000, you start to feel the beginnings of genuine financial security. A job loss would not devastate you. A medical emergency would not bankrupt you. The anxiety that accompanies financial vulnerability begins to lift. I remember when my investments crossed $500,000, it was the first time I truly felt that my financial future was secure regardless of what happened to my earned income. I could have stopped working entirely and lived modestly on investment returns. I chose not to because I loved what I did. But having that choice was transformative. The challenge at $500,000 is different from the challenge at $100,000 and $100,000. The challenge was building habits and staying consistent through small numbers at $500,000. The challenge is avoiding complacency and lifestyle inflation. Many people reach $500,000 and think they have arrived. They loosen their discipline. They upgrade their lifestyle. They save less because their investments are finally generating meaningful returns. This is a critical mistake that I have watched derail many promising wealth builders. $500,000 feels like a lot until you calculate what it actually provides. At a 4% withdrawal rate, $500,000 generates $20,000 per year. That is not enough to live on for most people. You are not yet financially independent. You are not yet secure against a 30-year retirement. You have made tremendous progress, but the journey is not complete. The correct response to reaching $500,000 is to double down on the habits that got you there. Keep saving aggressively. Keep living below your means. Keep letting compound interest do its work. You are in the final stretch. Now, do not slow down when you can finally see the finish line. Let me share a cautionary story about the $500,000 threshold. A colleague of mine reached $500,000 in his early 40s. He had been disciplined and frugal for 20 years. He had done everything right to get there. Then he made a decision that seemed reasonable. He withdrew $100,000 to buy a vacation property. He figured he had earned it after years of sacrifice. He figured the remaining $400,000 would continue growing. He never caught up. The vacation property came with property taxes, maintenance, insurance, and the temptation to spend more money improving it. His savings rate dropped because his expenses had risen. The $400,000 grew, but more slowly than the original $500,000 would have. He eventually sold the property at a loss when he realized it was preventing him from reaching his retirement goals. That detour cost him about 10 years of progress toward financial independence. The lesson is that $500,000 is a critical threshold where decisions have outsized consequences. Keep your lifestyle stable and let the money compound. And you reach $1 million relatively quickly. Inflate your lifestyle and extract capital for consumption, and you may never reach the next level. Here is my specific advice for someone at the $500,000 milestone. Resist the urge to upgrade your lifestyle. The house you live in, the car you drive, the vacations you take should remain roughly constant. Your growing wealth should go to investments, not consumption. Consider increasing your savings rate if possible. You are now accustomed to living on a certain amount. Any income increases can go entirely to investments since you have proven you do not need them for lifestyle. Pay attention to asset allocation at $500,000. A major market crash can cost you $200,000 or more. Make sure you have enough stability in your portfolio to weather volatility without panic selling. Start thinking about tax optimization. At this level, taxes become a meaningful drag on returns. Maximize retirement accounts. Consider tax loss harvesting. Think about Roth conversions. Small improvements in tax efficiency compound significantly over decades. The third milestone, $1 million, is where everything changes. This is the number that defines wealth in the popular imagination. It is the goal most people set when they start investing. Reaching it feels like arriving at a destination, even though it is really just another point on an ongoing journey. At $1 million, the mathematics become extraordinary. 10% returns generate $100,000 annually. For most people, that exceeds their total earned income. Your money is generating more wealth each year than you could create through labor. You have crossed a threshold that fundamentally alters your relationship with work and money. At a 4% withdrawal rate, $1 million generates $40,000 per year, combined with Social Security. That is enough for most people to live comfortably in retirement. You have achieved what previous generations called financial independence. You no longer need to work for money. You can choose to work for other reasons or not work at all. The psychological impact of reaching 1 million is profound. The anxiety that accompanies financial uncertainty fades. The fear that kept you awake at night, wondering if you would have enough, disappears. You have enough, not enough for private jets and mansions, but enough for security, comfort, and freedom from financial worry. I remember crossing 1 million vividly, though it happened long ago. The number on the page was 7 figures instead of 6. It felt like crossing a border into a different country. The rules were different here. The possibilities were expanded. A weight I had carried without fully realizing it was lifted from my shoulders. Let me share what changes practically once you reach $1 million invested. You can weather any economic storm, recessions, job losses, market crashes. None of these represent existential threats anymore. You might see your portfolio drop temporarily, but you will survive and recover. This security allows you to take career risks, business risks, and investment risks that would be reckless without a financial foundation. You can be generous in ways that were not possible before. You can help family members who are struggling. You can support causes you believe in. You can give without worrying about your own security. This capacity for meaningful generosity is one of the greatest benefits of wealth. You can say no to things you do not want to do. You do not have to stay in a job you hate because you need the paycheck. You do not have to tolerate situations that drain you because you depend on someone financially. You do not have to accept circumstances that conflict with your values because you have no other options. Money provides the freedom to align your life with your preferences. You can think long-term in ways that were impossible before. You can invest for decades without worrying about short-term needs. You can plan for retirement without anxiety. You can consider legacy and what you want to leave behind. The time horizon of your thinking expands dramatically. The challenge at 1 million is finding meaning beyond accumulation. For years, your goal was to reach this number. Now you have reached it. What comes next? Some people continue accumulating out of habit, never enjoying the freedom they worked hard to achieve. Others swing too far and spend recklessly, undermining the security they built. The healthiest response to reaching 1 million is gratitude combined with perspective. You have achieved something most people never achieve. You have security that previous generations could not have imagined. You have options that money provides and constraints remove that money eliminates. Let me now bring these 3 milestones together and share the principles that connect them. The most important principle is that each milestone makes the next one easier. The habits built during the journey to 100,000 carry you to 500,000. The momentum generated at 500,000 propels you to 1 million. The discipline and patience required at each stage become easier as the rewards become more visible. The second principle is that time is your greatest ally. At 10% annual returns, money doubles roughly every 7 years. 100,000 becomes 200,000 in 7 years. 200,000 becomes 400,000 in 14 years. 400,000 becomes 800,000 in 21 years. The longer your time horizon, the more powerful compound interest becomes. The third principle is that consistency matters more than brilliance. You do not need to pick winning stocks or time the market. You need to save consistently, invest consistently, and hold consistently. The boring approach beats the exciting approach almost every time over long periods. The fourth principle is that lifestyle inflation is the enemy of wealth building. Every time you increase your spending to match your income, you reset the clock on wealth accumulation. The path to financial freedom runs through sustained frugality, not through ever-increasing consumption. Let me close with practical guidance for wherever you are on this journey. If you have less than $100,000, focus relentlessly on your savings rate. Cut expenses, increase income, automate contributions, ignore market fluctuations. Your job right now is to reach the crossover point where compound interest takes over. Everything else is secondary. If you have between $100,000 and $500,000, stay disciplined and let momentum build. Do not be tempted by lifestyle inflation. Do not get discouraged by market volatility. You are in the accumulation phase where consistent behavior produces predictable results. If you have between $500,000 and $1 million, you are in the home stretch. The finish line is visible. Do not slow down. Do not get complacent. The next few years of continued discipline will purchase decades of freedom. If you have reached 1 million, congratulations. You have achieved genuine financial security. Now the question becomes what you will do with the freedom you have earned. Choose wisely. Your remaining years are precious, and you finally have the resources to spend them exactly as you wish. Let me share some additional insights about what separates people who successfully navigate all three milestones from those who get stuck along the way. The people who make it share certain characteristics I have observed consistently over many decades. They have absolute clarity about why they are building wealth. Not just to have money sitting in an account, but to achieve something specific that matters deeply to them. Freedom from anxiety, security for their family, the ability to help others in meaningful ways. Time to pursue work they find meaningful rather than just lucrative. This clarity of purpose sustains them through the difficult early years when progress feels impossibly slow and the sacrifices feel overwhelming. They also possess the ability to delay gratification consistently over very long periods. This is not about deprivation or suffering or living a joyless existence. It is about understanding at a deep level that current sacrifice creates future abundance. They can hold two time frames in their mind simultaneously, genuinely appreciating what they have today while working steadily toward what they want tomorrow. Neither time frame dominates to the exclusion of the other. They maintain emotional equilibrium during both good times and bad. When markets soar and their portfolio values spike, they do not become overconfident or take excessive risks trying to maximize the moment. When markets crash and they watch months or years of progress seemingly evaporate, they do not panic or abandon their strategy. They understand viscerally that volatility is the price of admission for superior long-term returns. They pay that price willingly and without complaint because they understand that the alternative is far worse. They continuously educate themselves throughout their lives, not just about investing mechanics, but about psychology and behavior and the science of decision-making. They read books written by people who have succeeded and people who have failed. They study history because patterns repeat. They learn from the expensive mistakes of others so they do not have to pay tuition on every lesson themselves. This commitment to learning compounds just like their investments. They deliberately surround themselves with people who support their goals, spouses who share their values about money and the future, friends who understand and practice delayed gratification themselves, mentors who have walked the path before them and can provide guidance at critical moments, communities of like-minded investors who reinforce good behavior during the difficult periods when giving up feels tempting. They understand that environment shapes behavior powerfully, and they design their environment with intention. The people who get stuck at one of these milestones, who never quite make it to the next level despite earning enough to get there, also share certain characteristics worth understanding if you want to avoid their fate. They lack clarity about why they are building wealth, without a compelling reason that truly matters to them at a personal level. The sacrifices feel arbitrary and pointless. Motivation fades when times get hard. They eventually find excuses to spend rather than save, because saving has no meaning beyond a larger number on a screen. They struggle constantly with comparison to others. They see neighbors buying bigger houses and driving nicer cars. They see colleagues taking expensive vacations to exotic destinations. They see people on social media apparently living wonderful lives of luxury and adventure. They feel like they are falling behind even when their net worth puts them ahead of 90% of the population. This comparison trap leads them to inflate their lifestyle prematurely, spending the resources they need for milestones on keeping up with people who are probably struggling with their own finances. They react emotionally to market movements instead of rationally. They panic during downturns and sell at the worst possible moments, locking in losses that were only temporary. They get greedy during rallies and buy at peaks when valuations make no sense. Their emotional behavior destroys the returns that the market would have delivered automatically if they had simply done nothing. They fall for get-rich-quick schemes repeatedly. Tired of the slow pace of traditional investing, they take excessive risks, hoping to accelerate their progress. Someone tells them about cryptocurrency or options trading or some hot stock that absolutely cannot miss. Sometimes they get lucky for a while and their bad behavior is reinforced. More often they lose significant capital and have to start over from a lower base. Each reset pushes their milestones further into the future until retirement arrives before wealth does. They allow lifestyle inflation to consume every raise and every bonus. Every time their income increases, their expenses increase to match or exceed it. The gap between income and expenses, which is the only source of investable capital, never widens no matter how successful they become. They earn more and more over their careers, but save no more than they did years earlier. The lifestyle treadmill runs faster and faster, but takes them nowhere. Understanding these patterns can help you avoid the traps that catch most people. You are not destined to follow the same failed path as everyone else. You can learn from observation. You can choose deliberately. You can reach all three milestones and experience the transformation that each one brings to your life and your psychology. Let me also address the question of what comes after 1 million, because the journey does not end at that milestone, and understanding the road ahead can help you navigate it with wisdom. After 1 million, the milestones continue, but their meaning changes significantly. 2 million provides additional security and cushion, but does not fundamentally alter your daily life the way the first million did. 5 million provides the ability to live extremely well, even in expensive areas, and to leave significant wealth to heirs or causes. 10 million and beyond enters the territory of true abundance, where almost any material desire becomes easily achievable. But here is what I have observed over my many decades of watching wealthy people. Happiness does not scale with wealth beyond a certain point. The jump from 100,000 to 1 million dramatically improves quality of life and reduces daily stress. The jump from 1 million to 10 million improves it noticeably, but far less dramatically. And beyond 10 million, additional wealth has almost no measurable impact on day-to-day well-being or life satisfaction. The activities I enjoy most cost very little money: reading books and company reports, thinking about interesting problems and puzzles, good conversation with people I respect and admire, a simple but well-prepared meal, time spent with family and friends. These pleasures were fully available to me when I reached my first million. Having vastly more wealth has not made these activities better or more enjoyable or more satisfying. The marginal utility of additional wealth declines rapidly. Once you have enough for security and comfort, enough is different for everyone based on their circumstances and values and location. But for most people, it falls somewhere between 1 million and $5 million. Beyond that amount, you are accumulating for reasons other than personal happiness or daily security, perhaps for legacy and the ability to make meaningful impact, perhaps for the intellectual challenge and satisfaction of building something large Perhaps because you genuinely do not know what else to do with your time and energy, and it is the game you know how to play. Understanding this reality can help you make wiser decisions about when to shift from aggressive accumulation to thoughtful enjoyment and contribution. Some people accumulate forever and never truly enjoy or deploy what they have built. They die with full accounts and empty lives, never having experienced the freedom their wealth could have provided, never having used their resources to make the impact they could have made. That is not wisdom. That is a different kind of poverty masquerading as success. Other people enjoy too soon and too freely and run out of resources. They reach 1 million, declare victory prematurely, and spend as if the future will somehow take care of itself through magic. When the future arrives with its long years and rising costs, they find themselves struggling when they should be secure. That is not wisdom either. That is short-sightedness that leads to genuine hardship during the years when you are least able to recover through additional work. The wise path threads carefully between these extremes, build to sufficiency, and then a margin beyond for safety. Enjoy sufficiency while maintaining and protecting it through prudent decisions. Do not sacrifice the present entirely for a future that may never arrive or may arrive very differently than you expect. Do not sacrifice the future entirely for pleasures that will be forgotten tomorrow. Find the balance that serves both the person you are today and the person you will become in 30 years. These 3 milestones changed my life in ways I could not have anticipated when I was an 11-year-old buying my first shares of stock with money from my paper route. $100,000 gave me confidence that I could build wealth through patience and discipline. $500,000 gave me security that no job loss or economic downturn could threaten my basic well-being. $1 million gave me freedom to spend my time on work I found meaningful rather than work I needed for survival. Each milestone can do the same for you. The mathematics are simple and unforgiving. The time required is long and cannot be shortened without risk. The discipline demanded is real and must be sustained for years and decades. But the destination is achievable for almost anyone who earns a reasonable income and is willing to do the sustained work that wealth building requires. Start where you are with what you have right now. Use the resources and opportunities available to you today, not the ones you wish you had. Do what you can this month and this year, and trust that consistent action accumulates into remarkable results over enough time. The milestones will come if you stay the course through the difficult early years and the tempting middle years and the complacent later years. That is what I did when I was young and had nothing but ambition and discipline. That is what worked over 8 decades of investing through booms and busts, wars and peace, inflation and stability. And that is what will work for you if you have the patience and persistence to see it through to the freedom that waits on the other side. 100,000, 500,000, 1 million, 3 numbers that change everything, 3 thresholds that transform your relationship with money and work and time, 3 milestones that are waiting for you to claim them through sustained and intelligent effort. The journey begins today with whatever you can save and invest this month. Everything else follows from that beginning.